Hello, welcome to today's edition of the 2 Minutes Conversation. My name is Yao Sompa. In our previous conversations, we've been talking about debt. We started with a conversation about what debts are in an economy. Today we'll look at financing beyond the debt. Primarily, an entrepreneur has two varied options with hybrids in the middle. You go for the debt option, which we talked about last week, or you go for an equity. An equity is where you sell portions of the enterprise for funding. And so in an equity, what you're promising the investor is a share in the valuation of the enterprise. The typical idea of an equity started with voyages across the sea. The entrepreneur who finances the journey wants to be distant from the underlying risks or the perils at sea. And so they create an entity, put the entire investment in the entity, and shares among each other in proportions to the money they've put in. Now, anybody who finances the enterprise, the value of their loss is limited to the value of the money they put in the enterprise. Two things. One, it grants you a right to share in the assets of the enterprise in the future, but it also gives you a portion of the earnings of that enterprise. If you're thinking about an equity to finance your project, the real underlying question is, are you prepared to share the future assets and the potential earnings with other persons? Many of us have not explored equity as a function of building financing or raising financing for our business, but it is an important means of raising funds. Imagine you're doing something, you need an engineer, you need a lawyer, you need a doctor. You may need physical cash to hide these resources, but if you could partner, you would raise those funding through the skill sets of each of them in bringing to the pool of that investment without needing an outflow in your cash flow. On debt, which is a contract for more money, and equity, which is a share in the valuation of the future assets and earnings of the enterprise. Think about a community around the idea. How do I build a community of trust? Trust being the foremost currency as to how I finance the business. I know there are so many things and so many risks with partnership, particularly when the trust environment is so low. Collaborators in the form of equity, partnership, acceleration, and incubation can be problematic. And so my message for today is this. In financing, thinking about debt and equity is important, but also think about trusting community, which can be a little more important than the baseline debt and equity conversation. So my friends, in this conversation, the emphasis is on thinking about a community beyond debt and equity, in thinking about financing in a more community-based approach to it. In our subsequent videos, we will explore other forms of financing beyond these community-based fundraisings. It's been an honor bringing you this episode. My name is Yao Sompa. I do look forward to engaging with you in our subsequent videos. Uhuru.